So you mentioned earlier talking about some of the businesses that have actually, sort of thrived during COVID. Do you have an example of a business that you've either seen or worked with that sort of reflects the positive and negatives of looking back on the performance of the last 12 months?
So I valued a business in the construction sector that had furloughed staff initially and has received quite a substantial amount of furlough payments, therefore, from the government under the job retention scheme. But actually, they have managed to since then recover and catch up on quite a lot of the work. And so when I analysed their numbers, what I actually found was probably they had almost a net benefit from the relief that they've had during the year. So they lost a couple of months of sales and margin, but when I compare that to the furlough income they'd actually made a surplus, a couple of £100,000 surplus in that period, because they haven't lost that work forever. They will recover it. So it's not like it's just a totally sunk cost. They will catch up on that work. Those orders are still there. And so we have to actually be careful not to not to just accept the figures as they are for 2020 accounts, but to actually unpick them a little bit and understand, okay, well, if you received £500,000 worth of job retention scheme furlough income from the government, presumably that means you probably spent about £600,000, given that it was 80% relief generally, on staff that were not doing any production for you, anything useful. They were on furlough, they couldn't work. But actually, did you lose that much work? And if you didn't, actually, there is an argument that you have actually made a small profit from that income. And as we look forward again into next year, what does next year look like when you haven't got furlough income and you have got all those staff wage costs going through? So it points again to that looking forward point. And then the second part is the debt burden. If you have had to take more debt on, and we know from the statistics there is billions of pounds of new debt has been taken on under the bounce back loan and CBILS loan schemes. And in my experience, there's a good number of businesses that have taken that debt because it's actually been very easy to get that hold of that debt, and they're just holding it, sometimes with the cash in the bank, quite appropriately, because they're just scared of what might come and they want to make sure they've got funds available for what might come. And therefore, in 6 to 12 months' time, when the anniversary of those loans starts to come through, businesses will either have the choice of just saying, okay, actually, I didn't need it, so I'm going to repay it in full before interest starts, in which case we've had false debt and false cash for the last year. Or businesses have needed it, and now they've got to start repaying it. And because they've needed it, that probably suggests their cash flow otherwise is pretty weak, or has been. And that will therefore limit the funds available from new profits being generated to reinvest in growth, because they're firstly having to reinvest in paying down the debt that they've now added onto their balance sheet. So there is a sort of question mark over businesses' ability to grow out of recession. And I think this, and I say recession, that's effectively what COVID's creating. And on the other hand, we recognise that owner-managed businesses, which is our marketplace, actually are often the businesses that come out of recession quickest, because they can make decisions quicker than corporates. They can react to the market quicker. So I'm very much anticipating that having the funds to grow, having the facilities available to grow in the future, in particularly probably the second half of 2021, is going to be vital. And it's certainly conversations that we are trying to provoke now with our clients and contacts and referrers to say, look, what are you doing to prepare for unlocking, for growth to restart when all of your staff are off furlough, the furlough scheme no longer exists, we're not in lockdown, and we're beginning to actually be able to head back towards what we might like to think of was normal, but what is normal, but actually, the new normal going forward. What does that look like, and have we got the facilities and cash flows available to do that? And that's going to be quite a key question when thinking about valuation, because if a business can't obtain any more debt, then it won't be able to grow. So if the valuation is based upon a plan that requires new funding that it doesn't look like it's going to achieve, then I'm going to have to adjust for that in my consideration of how those projections actually are going to come to fruition. If I don't believe them, then I can't use them really in the valuation. If you are growing your business, if what you're trying to achieve is some kind of outcome, such as you want to sell at some stage, how do you know when's the right time to sell? Have you got in mind how is valuation a useful tool for that? And what I would try to answer in that is to say, well, look, most of us have a level of what we believe we can achieve in our businesses, the optimum, if you like. And that's limited typically by management's ability, management's confidence, owners' willingness to keep investing, and a timeline towards when an owner wants to realize the value of his shares. So actually, if you understand strategically, for instance, the timeline the owners, the shareholders have for ownership and their objectives on what they're actually trying to achieve, if somebody's trying to triple their cash investment, a typical private equity house, their minimum approach these days would be to triple the value of the money they put in 3 years. Well, that's quite an easy way of then saying, okay, so if that's what we're trying to achieve, what do we have to do to achieve it? And actually having a valuation check-in regularly is quite helpful, because you can say, right, well, this is what we need to do. This is the gap between today's valuation and the target valuation on which we know that our private equity investor is going to be willing and happy to exit. And if we can do better than that, everybody's happy. But we know we need to be achieving that, or we've got to change the perspective of the private equity investor that we're never going to reach that target because the world's turned 90 degrees to the direction we were going in.